This is task 10.12, where we calculate the value of stock on sold, the cost of sales, and the gross profit using first in, first out method and using the weighted average method. And then we have to explain why the weighted average method results in a lower gross profit than the first in, first out. On the next page, they give us all the information. We had an opening stock. We had purchases of stock, purchase of stock, purchase of stock, purchase of stock. And then we've got also total sales for the period, where 1,286 units were sold. Let us take a look at the first in, first out method. The first thing that we really need to do here is to calculate the cost of sales, or the purchases, to calculate the purchases for the first in, first out. So I'm going to start over here. I'm going to have the purchases, which is 300 units of stock at 15 Rand. So that is 300 at 15 Rand, gives us 4,500. Then we had another 200 units at 18 Rand a unit, gives us 3,600. And then we had another 250 units at 20 Rand a unit, that would give us 5,000. And then lastly, we purchased another 300 units at 23 Rand a unit, gives us 6,900. That would be our purchases only. So all of these purchases. Then we have to add our opening stock. And that we had 500 units at 10 Rand a unit, which would be 5,000. So we take the 4,500 plus the 3,600 plus the 5,000 plus 6,900. So our total purchases is actually 20,000. And the stock that's available for selling, so plus the 5,000, gives us 25,000 at this stage. But this is not our cost of sales. This is just what is available for sales. What we have to do now, we have to take a look at our number units on hand, which we had. We started off with 1,980 units. So we have to take out, 1,286 units. 1,286 units we started off. Out of that, first in, first out means we have to subtract the 500 units opening stock we had. So that would be 1,286 minus the 500 units. That would give us 786 units. We purchased another 300 units, so they would be gone first. So we subtract that. That would become to 486 units. Then we purchased another 200 units. That gives us 286 units. And then we purchased another 250 units. That would give us 36 units. And then lastly, we purchased another 300 units, but we only sold 36. So we have to take the 300 minus 36, gives us 264 units left at 23 Rand a unit. Therefore, the units unsold would be 264 units, and that is at 300 Rand per unit, which we sold. So our closing stock would be 264 units at 23 gives us 6,072. That would be our closing stock. Okay. If we take a look here at number of units on hand, I did it here manually. Let's do it here officially. So we had our opening stock of units. We had 500. Our purchases was 300 units plus 200 units plus 250 units plus 300 units. So that would give us 1,050 units. We sold units 1, 2, 8, 6. So 500 units plus 1,050 minus 1,286 gives us 264 units. Just to reiterate, we sold 1,286. We first sold off our opening stock. We sold off our first purchase. We sold off our second purchase. We sold off our third purchase. We left with 36 units that we still sold. So we purchased another 300 units, but of that we only sold 36. So what is left over is 264 at 23 Rand per unit, because that's part of the units that's left over. So the total value of stock unsold must be from the last purchase. So that would be the 264 units times the 23 Rand a unit, and that gives us 6,072. So that would be our closing stock. Okay, cost of sales. Cost of sales, we usually work out as our opening stock. In this case, our opening stock was 5,000. Our purchases, we worked out, here's all our purchases of 20,000. Minus our closing stock, which we worked out as 6,072. So we would take the 5,000 plus the 20,000 minus 6,072 gives us a cost price of 18,928. 18,928. 8. And that would give us cost of sales, because again, we're using periodic system, which is opening stock plus purchases minus cost of sales. To work out our gross profit, we have to take always our sales minus debtors allowances. In this case, there is no debtors allowances, there's only the sales. So the sales was 28,148. And we subtract our cost of sales. Cost of sales we worked out as 18,928. So we would take the 28,148 minus 18,928 gives you 9,220. And this is calculating, or the valuation of your stock, using first in, first out method. We've got, the important thing is, we had sales. We sold off our opening stock first. Then our first purchase, then our second purchase, then our third purchase, and part of our last purchase. Let us take a look at using the weighted average. Opening stock of 500 units. We had purchases of 1,050 units. If we take a look back at our previous part of the exercise, we said we purchased 300 plus 200 plus 250 plus 300. That gives us 1,050. We sold units of 1,286. Therefore, these calculations are exactly the same. We're still left with 264 units at the end. However, the value is now going to be different, because in this one, as we sold off each one, we found that our end value, the 264 that was left over, was at 23 Rand. With the weighted average method, we're not going to use this. Now we're going to do the following. We've had there the total purchases of 20,000. The amount of units, let's go and add up all the units here. We had there 300 units, plus another 200 units, plus another 250 units, plus another 300 units. So it gives us, we purchased 1,050 units. 50 units, plus we had an additional 500 in opening stock. So this is your purchases for units. This is your opening stock. So that gives you 1,550 units. We had here all the units and the opening stock adding up to 25,000. So the value is 25,000. Therefore, the stock value is calculated as follows. It's the 25,000 divided by the 1,550. So that would be 25,000 divided by 1,550. And that gives us 16 Rand and 13 cents per unit average value. We took our purchases plus our opening stock, gave us 1,550 units. The value of that stock was 25,000. So therefore, the average value per stock item is 16 Rand and 13 cents. Now, we've had 264 items left over. So we will take the 264 items times 16 Rand and 13 cents. So that would be 264 times 16.13 equals 4,258 and 32 cents. So this would be our closing stock value, which is important because we worked out the closing stock value for the other one, total value for the first in, first out method would be 6,072 because we used 264 times 23, first in, first out method. Here we used weighted average method. We added all the units available for selling, divided by the value for all those, or the value of those units divided by the amount of units, gives us now a lower price, a lower average price of 16 Rand 13. So the cost of sales in this case would be as follows. We'd have opening stock stays the same at 5,000. Our purchases stays the same at 20,000. However, our closing stock now is at 4258.32 in brackets. So therefore, whereas over here in the first in, first out method was 6,072, here we've got a lower price for our closing stock because of the weighted average. So therefore, it would be the 5,000 plus the 20,000 minus 4258.32 gives you a cost of sales of 20,741.68 cents. So therefore, our cost of sales is way more than it would be for the first in, first out method, because there we've got a cost of sales of 18,928. Gross profit, always sales minus debtors allowances. In this case, it would be the same, 28,148, which is the amount of what we sold. The 1,286 units were sold. Total sales was 28,148. We calculated cost of sales, in this case, to 20,741.68 cents. So if we subtract the two, 28,148 minus 2741.68, it gives us 7,406.30 32. If we take a look at our first in, first out method, which we had, selling price is the same, but the value of our stock, the value of our purchases is completely different. This is the weighted average method. Here, we made more profit than we made here. So what would be the difference between the two? And that is 10.12.2. They want us to explain results in a lower profit than the first in, first out method. In the first in, first out method, as stock came in, we sold off the stock. So therefore, the stock rose as we purchased them. So we would sell this at 15 Rand, or the cost would be 15 Rand. Whereas with the weighted average method, the cost would actually be the 16 Rand and 13 cents. The most recent price is assigned to the value of the stock. That's with the first in, first out method. The most recent price is assigned to the value of the stock, which results in a lower cost of sales and higher gross profit. With the weighted average method, the cost price is average for all of the stock. So all of the stock actually uses the same cost price, which works out in this case to 16 Rand and 13 cents. If we add up all of these plus opening stock, and get the average of all of these purchases is 16 Rand and 13 cents. Whereas with the first in, first out method, the cost price or available for sales is slightly different, is 25,000. And that concludes exercise 10.12.